A simple way to reduce your trading risk is to trade with the trend. That's why we use tools such as moving averages to find and trade the trend. But however, this is not enough because moving averages tend to give out a lot of false signals. But if you use the right tools along with the moving average, trading can become simple and profitable to you. Today, we'll see one such indicator that works beautifully with the moving average. Commodity Channel Index, or CCI, is a momentum-based indicator that works like magic when used with moving average. CCI basically compares the current market price with the historical average price and tells us whether the trend is up or down. CCI has two key areas, plus 100 and minus 100. When the signal line crosses above plus 100, it indicates bullishness in the stock. When the signal line crosses below minus 100, it indicates bearishness in the stock. So for this strategy, we're going to use two simple moving averages. One is 27-period moving average, and the other one is 9-period moving average. And for CCI, we are using the default value 20. Now, taking trades with this strategy has 3 steps. Step 1 is picking a stock that is strongly trending. Step 2 is to wait for a pullback. And step 3 is to look for the CCI signal. Let's see this with an example. Now, here in this example, the 9-period moving average is below the 27-period moving average. So the trend is clearly bearish. And also, the distance between the moving average is wide. So the sell trend is clearly strong. And this satisfies our step 1. And over here, we have a pullback into the moving average. And that is our step 2. And now for step 3, we wait for the CCI to break down below the minus 100 zone, which we see right over here. And as a confirmation to the selling pressure, we see a consolidation breakdown. And the next day, the price continued to fall. And here you can enter short upon next day's open and place your stop loss just above the 27-period moving average. And once this candle ends, you can transfer your stop loss to its high. And for the target, you can use 1:1.5 or 1:2 risk reward as your targets. And here in our next example, we have a long trade in Strides Pharma. The price here is an uptrend, and we see a pullback into the moving average. So this satisfies our step 1 and step 2. But for step 3, there is a slight change in this CCI signal because the CCI here doesn't break out of the plus 100 zone, but instead it is just taking support at the plus 100 zone. And this is also a valid pattern because the signal line is above the plus 100 area, which is basically a bullish indication. And to confirm the bullishness, we have a bullish engulfing pattern, which is basically confirming our buy entry. So we can enter our trade after this bullish engulfing pattern and place our stop loss at this nearest swing low. And the target would be 1:1.5 or 1:2 risk reward range. And here are some more examples based on the concept. And that's how we can precisely time our entries using the moving average and CCI. And when you trade with a trend, you're basically reducing your risk because the momentum is completely in your favor. So in this strategy, by using the moving averages, we are taking the trade in the direction of the trend, which reduces our risk. And by using the CCI, we are avoiding all the false signals given out by the moving average. In our next video, I'll see you with another interesting strategy. So stay tuned.